All right, time out. Let's just take a few minutes to pause. Just when we thought we'd already reached new lows in the stock market, it's getting worse out there. If you started investing over the last couple of years, especially in the last 1 or 2, you're probably pulling your hair out right now thinking about whether or not you should be selling everything and just calling it a day. Now, I don't have all of the answers. I've made plenty of mistakes myself, but what I can do is at least show you what some of the best minds in the investing business have said when it comes to when you should actually sell. Sure, it's easy to buy stocks on the way up when everyone thinks they're a genius, especially in a bull market, but the moment things take a turn for the worse, you really find out what you're made of. And as the saying goes, when the tide goes out, you find out who's been swimming naked. Let's first just imagine a scenario that I think summarizes where we are right now. Say you own this house. You've owned it for a couple of years now, and every single day, an estate agent comes round and gives you a price that your house is worth and offers you money. Most days, she says that the price is going up.
Hello there.
Just by small amounts, but, in that general direction. Some weeks it's down a few thousands, and others you're up by a few thousand too. Then, all of a sudden, things get a bit crazier. Today, she says your house is now worth 50% more than what you paid for it. You feel pretty good about yourself, but then you also remember that if you did accept that offer, you'd also need to buy another house too. So you say, thanks, but no thanks. Then, over the next few weeks, things get a lot worse. Every day, the price she offers goes down and down, and even further down. Your neighbours start to sell and take their money. You start to get really worried, and you're seriously starting to think about selling your house because it might just go lower and lower until you've got nothing left. However, step back for a second and we start to see a lot of comparisons with investing in the stock market. When you first bought this house, you did a full structural survey, everything was sound, no leaks in the roof, and none of that Japanese knotweed in the garden. You bought it with a mortgage that you could afford, the bank tested your outgoings and made sure that they were happy to give you the money, and you also bought it because you wanted to own it for the very long term. Fundamentally, every time that estate agent comes over and gives you your offer, nothing about your house has changed. It's just the market being the market. Sometimes people are prepared to pay more for it, and other times people are prepared to pay a lot less. It could be for a huge number of reasons, but at the end of the day, it's just the usual story of supply and demand. Over the really long term, the house will likely appreciate in value, but in between a long period of 10 or 20 years, there could be many times when the house gets super overvalued and also crazy undervalued too, at least when compared to what you bought it for. You've got no control over the price of what the market will do. All you can do is control your own decision making. Now, hopefully you see a lot of similarities with how the stock market works in this story. The price of a stock can change all the time, just like the value of your house. But if nothing's changed about the fundamentals of your house, then the price is mostly irrelevant and something you should probably avoid looking at. One of the greatest investors of all time that you might have already heard of is this guy, Peter Lynch. He ran a famous investment fund, Fidelity Investments, for a long time. He averaged 29% per year as a return from 1977 to 1990, which beat the return of the wider market by a really long way. As well as knowing when to buy stocks and how to value the company, one thing he also spoke about was when to sell. And here's what he had to say about that.
When should you sell?
Well, you ought to find out why you bought a stock. If you're saying it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. You say, still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. I'll be able to write that down and follow that. That's what I do with the company. And that's your decision. That's how you sell it.
Okay, let's just break this down quickly. He's saying that you should sell a stock for a couple of reasons. Firstly, if you don't really know why you own it in the first place, you're just gambling. Secondly, it's all about the long-term fundamentals, or as Peter calls it, the story of the company. If the company's got great financials, very little debt, a high profit margin, and they're maybe in an industry that's also set to grow, then all of these things might add up to a great buy if the price is right. The issue is, if that story changes or the growth slows down to a point where you can no longer justify it, then you might want to consider your position. Otherwise, ignore the price. Remember that it's just like the estate agent coming around every day with your offer on your house. Here's another one of the thoughts of an all-time great that adds on to what Peter Lynch was saying earlier. Warren Buffett has a very similar thought process here when he was asked a question at one of his annual Berkshire Hathaway meetings by someone on why they've sold some of their stocks before. Other than saying that he would sell a company if he thought there was an even better deal to get another company, Buffett's always said that his ideal holding period is forever. However, listen to him speaking here about one of the biggest reasons that have led him and Charlie Munger to sell company stock before. Just before we head to the Oracle of Omaha, I know everything is looking red right now, but if you could help turn the like button blue by giving it a gentle nudge? That would really help out small channels like mine. Now that that's done, let's listen to the big man himself.
We would sell if we needed money for something else, but that has not been the problem in the last 10 or 15 years. That 40 years ago, my sales were all because I found something that I liked even better. I hated to sell what I sold, but I also didn't want to borrow money. So I would reluctantly sell something that I thought was terribly cheap to buy something that was even cheaper. Those were the times when I had more ideas than money. Now I've got more money than ideas, and that's a different equation. So now we sell really when we think that when we're reevaluating the economic characteristics of the business. In other words, if you take them, don't want to name names, but take a stock we've sold of some sort. We probably had one view of the long-term competitive advantage of the company at the time we bought it, and we may have modified that. That doesn't mean we think that the company is going into some disastrous period or anything remotely like that. We think McDonald's has a fine future. We think Disney has a fine future, and there are others. But we probably don't think that their competitive advantage is as strong as we might have thought, as we thought it was when we initially made the decision.
So this is a similar story then. If the moat of the company or the competitive advantage suddenly becomes weaker, then it might be a time to consider your position. Take Microsoft, for example, a company with an extremely strong advantage, both in their cloud business with Office 365 and their computer operating system. Unless someone else comes along with very deep pockets and really starts to make a better system that people and businesses want to use, Microsoft isn't going anywhere. On the other hand, think of businesses that have a much tougher time of being competitive and keeping their moat. Supermarkets and grocery stores are more challenging. They really don't sell anything that's unique. The profit margins are really small, so their competitive edge is about being as cost efficient as possible and using their massive buying power to get better deals among lots of other things. So that's one more thing to consider, and yet again, if nothing's changed, then it looks like there's no need to panic. And how about another great investor that doesn't get talked about much on YouTube? Joel Greenblatt. He's averaged 40% return per year across 2 decades with his funds back a few years ago. And here's what he said. The bad news is that selling actually makes buying look easy. Buying when it's relatively cheap, buying when there's limited downside, buying when it's undiscovered, buying when insiders are incentivized, buying when you have an edge, buying when no one else wants it. Buying kind of makes sense, but selling, that's a tough one. When do you sell? The short answer is, I don't know. I do, however, have a few tips. In summary, here are the tips that he wrote about in his popular book, You Can Be a Stock Market Genius. First up, he says, if there was an extraordinary case that when you bought the company, maybe you bought one that was nearly bankrupt or had been sold off, then as soon as the valuation catches up with the price, it might be worth considering taking your profits. Although he does say that this could take weeks or years. Ultimately, nobody really knows when. Secondly, he adds this by giving an example of a company called Charter Medical. He says, if you're buying an average company in a really challenging industry and the business starts to finally do well, investors start to take note and Wall Street starts to get excited by pumping up the price of the stock. Again, this could be another time to sell, especially if you feel like you've got what you wanted out of it. All of this sounds easy, doesn't it? Sure, you just sell stocks when they're high and buy them when they're cheap, but if it was all this easy, then we'd all do it. Unfortunately, the most difficult thing is trying to do all of this in the heat of the moment, when everything around you is turning red and people are panicking. Your biggest enemy is going to be what's going on up here in your head. Nobody likes looking at red investment accounts, especially if you've just started recently. You're thinking, it's just typical that all of this has to happen now, just as you got started. However, let me add some of my own investing experience here for you now and to go back on some of the basics that we often forget about. Firstly, none of us should be investing our money unless we're first financially secure. This doesn't mean having millions of dollars, but it does mean having high interest debt paid off and some form of emergency fund that allows us to cover our short-term expenses in the event of something bad happening. Whether that's 3 months, 6 months, or even 12 months, that's up to you. Completely up to you how much you need. But without that, there's no way you can make sensible investment decisions if you need to dip into your investments to pay for a new boiler or something. Secondly, you need to have a long-term investment mindset. And this is another thing that's so easily said when the markets are going up, but people throw out the window when things are going badly. Long-term would mean a minimum time frame of 5 years, but really, if you want to be successful in investing, then we're talking decades because that's how long it takes for compound interest to really work. For me personally, I've been investing on and off for nearly a decade, but I've made so many mistakes along the way and sold out of the market multiple times. I was doing the exact opposite of everything that I should have, and it was all because I hadn't learned enough that has only really become apparent in the last couple of years. And finally, this point may not surprise you, a lot of you who watch me frequently, but if you use broad market, low cost index funds like investing into the S&P 500 or even the entire world, then you don't need to spend a second of your time wondering about whether you need to buy or sell certain companies, because you just own all of them. If you're able to invest regularly every month with money that you can afford to invest over a very long period of time, then it's highly likely that you'll end up with a lot more money than where you started. As I showed in one of my other recent videos, there's been no period of time in the S&P 500 over a period of 15 years or more where you would have lost money. That's even when you'd had the worst luck of all and invested in the worst possible environment. This is why, for me personally, I invest most of my wealth into low-cost index funds, but then I do also enjoy a bit of stock picking as another part of my portfolio, where I'm happy with the risks and the additional work that it takes to do my research and hold my nerve when those bear markets come, like we're in now. When I look back over any time that I ever sold, it was always something I regretted because I never sold for the right reasons. It was always during a panic and a rush, and ultimately, if I had just continued to invest during the times when it looked hopeless, I would have been a lot better off. It's really not easy, and a lot easier to say that than actually do it. So if you needed this kind of reminder, I hope that's been useful. At the end of the day, everything lies with you. It's your decision to make, but make it with all of the information rather than on your gut feel or your emotions, as you'll probably just end up losing money and back at square one. And the last thing you want is to think that investing is just one big scam for rich people. If you do want to take a bit more of a time out before you sell any of your stocks, why not watch this video next, where I look at all of the things that investors should know before they get started investing. It might just help cool things off and stop you looking at your current portfolio. Or check out my latest portfolio update, which I did just before this last dip. Maybe take your phone outside, grab some earphones, and take a walk and listen to it. Anyway, drop me a like if you've enjoyed the video, subscribe for many more, and I'll see you in the next video. As always, happy investing.